evening. Welcome to the September edition of Your Financial Journey, where we hopefully will give you a little hope and some opportunity as we go forward here. If you're in Florida right now, you're wondering a lot about things with the hurricane and the weather as it is, plus the markets and all that. For the next hour, let's talk about some good things and see what we can do to make the most of all this. So I look forward to having some time tonight to talk about how we're going to work on creating, growing, protecting, and preserving your family's wealth in today's economy. You know, that's the title we use every month, but it really is what it's all about. And hopefully this time, as much as any, that will make sense. That fits for what you and I are trying to accomplish. So let's, okay, apparently technology, right? Oh, there we go. All right, so as a quick reminder, the disclosures are always the same. Any information we look at tonight is specific for the investments or the tax ideas or the investment ideas, etc. Please take time to review them in detail for you to make sure it makes sense in your situation, even if that includes involving your accountant or your attorney in some of the discussions, because as good as any idea could be, it may not be a good idea for you, and we want to make sure that we choose just the right programs for you. It's one of the reasons we take so much time to know you better to make the best choices possible. So again, please take time to review all of the details of anything we talk about before making any or taking any action. We will have a time for questions at the end, although depending on some of the chats, if you chat up a message and say, hey, can I get this answer now? We might, by prerogative, say, okay, let's do this one now because it might fit well. But if not, rest assured that by the end of our time tonight, we will have covered every question. So either raise your hand or type a question in chat, and we'll definitely take time to go through it. So tonight, we're going to talk about the current market and economic review. I know that's important to all of you because we've been talking to several of you over the last couple of weeks. And so I know that as I visited with clients, that has been one of those items that has been very important. We're going to take a look at some portfolio management diversification options that may work for you. I have a special thing that I've done tonight, questions and answers with Kendall Dunn from AAM, which I'll explain more about that in a minute. We don't normally do it this way, but based on the market and some of the changes that I'm going to explain tonight in my market and economic review, decided it might be good to spend a few minutes with what Kendall does in AAM to help you understand some opportunities that exist in your portfolio that probably most of you have never used in the past. We'll take a reminder of our wealth management apps to refresh you on what you should be using them for to accomplish your goals, because that's why I spend the energy for that. I was going to actually focus mostly on taxes tonight as we go into the end of the year, but I decided to just hit kind of a basics for it. And then in our next presentation, our next Your Financial Journey update in October, I'll drill down more on the tax strategies. But I did want to remind you of that because as we go to the end of the year here, this is the time to implement most of those strategies, because after December 31st, 98.5% of all those tax strategies are gone, and we have to get them in place before the end of this year for you to benefit from them. So we're going to cover that briefly, but I decided to use the time tonight to bring Kendall on and talk a little bit more about market issues, especially in light of some of the economic changes in the last 2 weeks. Then we'll have time for questions and a reminder of the next investor update for you. Again, as always, hitting the sort of the 4 primary engines of the economy, the leading indicators: GDP growth, business profitability, unemployment rates, and interest rates. As you can see, we're classifying those as minuses for Q1, Q2. We don't know Q3 yet, but that'll be coming out. Business profitability, plus minus right now. I mean, some are doing better than others. Most are struggling a little bit. Unemployment rates are still currently a plus, and then interest rates are a plus minus. They are increasing, which is having some negative impacts on the economy. But as I mentioned in previous times, and it's still true today, interest rates being up is helpful to seniors drawing income on, say, CDs or more fixed incomes. And it's still relatively low compared to historic averages for interest rates. So we classified that as a plus minus. So if you think of those 4 components as engines on a plane, one of the engines is running really well, 2 of the engines are running okay, and 1 engine's not doing so well right now. as we go through each quarter, we'll have more conversation about how that looks. The good, the bad, and the ugly of where we are right now, I'm just going to tell you up front, no matter who you're hearing this from, I would say currently we're in a shallow recession. It may deepen this next quarter, I don't know, but if I count what we had in Q1 and Q2, it is still a shallow recession. I was hoping that was going to be the end of it, but I kind of think that's probably not going to be the end of it. One of the reasons why I invited Kendall on here, and I'll explain more about that in a minute. Are we experiencing stagflation? Again, time will tell, but I would say it's looking more and more like we're going to have an inflationary economy while it's stagnating at the same time, but we shall wait and see on that. What's next? Well, I really kind of just hit the challenges I think we're facing and the opportunities that may make things a softer landing than what we had originally, or what may be apparent. So if I look at the challenges we're facing, historically high inflation, the Fed is raising interest rates, which is definitely a negative from a viewpoint of the economic view, identifying there's going to be more costs for companies, and so the Fed raising interest rates to slow down that inflation is both good and bad, but I'm going to classify it on this side as the bad side. We'll talk about the positive in a minute. Slow or no economic policy or governance at this point. It seems like the governance that we're getting is questionable at times and seems to be a little misguided, which is then impacting also how people are viewing the economy. Historically high energy costs at this point in time. Also recognizing that the European Union is planning to discontinue Russian oil in December. That's at least their commitment. You know how politicians are, that may not be the case, but if they do, that may have a huge impact on energy costs going forward. The Biden administration is also going to be discontinuing in November, withdrawing oil from the strategic reserve. They've been doing that, and that's part of the reason why the oil prices and gas prices have come down. But right now, the strategic reserve is at historic lows. This is the lowest it's been since 1984. It has not typically been used like it is right now, but the pandemic brought part of that on, and I think these higher prices with inflation have brought that on. Typically, the strategic reserve is designed to make it so that if we have a hurricane, for instance, and oil rigs are shut down, the reserve can be used to replenish that to keep the oil prices more realistic in the short term. Because we're at lows right now and we're entering hurricane season, I think that may be one of the things we'll see how problematic that is or is not. But again, between what the EU will do in December, if they do it, and discontinuing that withdrawal in November, those things concern me about where the cost of everything is going to be, with energy prices possibly going up as a result of that. While it is true that unemployment's low, labor shortages continue to plague many businesses. They can't find workers, and so that makes it harder for them to produce like they normally would. China has a zero COVID policy and has shut down either 8 or 9 cities, I can't remember which, and those cities are being shut down to protect the Chinese from COVID infections. At the same time, while I fully get that, that is also shutting down manufacturing, which, back to the EU for a second, their energy costs are significantly higher than ours right now, to the point where they're looking at 7 to 10 times the cost for their companies to run, their manufacturers to produce. And some of those companies are shuttering their doors, either short-term or long-term, time will tell. But that, plus what I just shared with China's zero COVID policy, that could continue to plague supply chain issues, which could then continue to mess with supply and demand, which would continue to mess with high inflation or inflationary issues. Potential major layoffs by corporations at end of year. That was part of what happened a couple of weeks ago when many of the Fortune 500 companies announced that they would be doing layoffs at the end of the year. That, combined with everything else, could potentially deepen and increase the length of the recession. And so that's really what was a big change. I was hoping for a much more shallow short-term recession. When we see a longer-term recession like that, that certainly has a much more negative impact upon the markets. And so this last couple of weeks, a number of pieces kind of came together and made me think this could be worse. And so we started taking some actions to help protect portfolios last week. So I'm going to explain more about that when I do the S&P 500 technical review. The opportunities, the things that could still kind of make things better. Rising interest rates for seniors' income needs, that could help. That certainly is something that they've been wanting for quite a while, along with an increase in Social Security benefits here at the first of 2023. Historically low interest rates. Even though the Fed is raising rates, the fact is the rates are still relatively low, and that certainly could have a positive impact on the economy and therefore the markets. Fed Chief Jerome Powell, is finally taking action to offset inflation. My concern is that it's too little too late. The Fed has often been that way, but they are trying to create a soft landing. I think it becomes harder and harder to believe that's going to happen, but I certainly remain optimistic that it will. But even if it doesn't, we've got plans in place to help protect against that and take advantage of some opportunities. We, as I've said before, have a large money supply right now. There is money in the hands of individuals and in the hands of corporations right now, and that money is seeking a place to go. And when that happens, that provides any place where money is flowing into with volume and velocity, that provides opportunity for growth in those areas. And so having that makes me think that could be a potentially good opportunity for the markets and the economy. And then finally, the midterm elections, it could be more of a conservative governance. It goes back and forth depending on who you listen to as to whether or not that conservative governance is likely. But if that were to happen, that probably would be viewed as a positive. And if that happens, that could also have some impacts on how deep or long-term or short and shallow the recession is. So as of this moment, those are things that we're watching. I wish I had a great, perfect answer for you to tell you what's going on. We don't, but that's why we make adjustments in portfolios to take advantage of opportunities and put you and I as an advisor in positions to make the most of what we have to work with. So as we look at the technical analysis, what we just reviewed is more fundamental analysis, what we think is happening in the economy or in various industries or in even securities when we break it down that way. Technical analysis tells us, should we be invested today? And so last couple of weeks, we've had some significant changes in market behavior that were not totally unexpected. It just happened a little faster than I was thinking it was going to. So let me switch to the actual interactive chart for that. Let's see here. I don't need to see me. There we go. All right. So what we're looking at here is the S&P 500, and I've taken it all the way back to 2000, just as a reminder, so you can see some of the comparatives of where we were before versus where we are now. We have several new guests on here tonight, and I wanted to make sure that they catch up to some of the things we've been talking about the last few months. If I go back here to January of 2000, what we see is we see a high. The market fell as a result of probably, certainly 9/11 was part of that, but Y2K spending in the previous 4 or 5 years. Market took a big dip, came back up. In 2007, we ran into the mortgage bond problem, and then the market took a bigger, steeper dip, actually deeper than the previous time. Then it returned after a period of time, and so by the time we got to 2013, we were actually back to where we had been back in 2001. Now, if a person just used a buy and hold strategy or had no other investments that were earning anything for them, they kind of just broke even unless you count dividends in there as well. We don't want to do that. We want to make sure that we're being proactive wherever possible and reactive whenever necessary. Now, having said that, if I compare this line to where we are today, you can see we're still significantly above that. If I tighten this up and I go to the pandemic, what we see here is this area right here. This is the high before the pandemic hit. So this is going back into, we'll move right here forward here to January, February of 2020. You can see that's the high we had. Again, if you compare that to where we are today, we're still above the high of the pandemic, pre-pandemic. So I think a lot of people have this nervousness that, oh my goodness, everything is over. It's not. There's opportunity. We just have to be thinking carefully and wisely about what that is. If we look at where the pandemic hit at its bottom, what we can see is that we're significantly above that. And so consequently, we've got still a lot of room here before we have to be panicked, I think, like some people are sort of feeling right now. It's not really necessary, but it doesn't mean that we shouldn't make some good decisions along the way. So if I change this one more time, let's change it to just year to date. Now what we see is we're looking at January of this year, which was at a pretty good high right now. So we had a pretty decent high on the markets at that point. And as we go forward, we see the market tanked, dropped below the 50-day. Again, we're doing some quick technical analysis, went down, broke out. And then as you may remember in previous discussions, is this that period of time? No, it is not. That's what I thought. There we go. That should be that. There we go. So what we're seeing here, why is that looking so different? Sorry about that. Let's change this to year to date and update. There we go. There we go. No, that's still not it. Technology as it is. Why is this? Do it this way then. Actually, I want to just do a complete reset so that we can get this right. All right, and then we'll set it for 1 year. All right, that's closer to what I'm looking for. Sorry about that. So here we are, December 21. Yeah, okay. So here we are. This is January 22, and then we move in. And what I've shared in the last couple of months is we've dropped below the 50-day moving average. And much like we expected in 2008, we expected to come up and hit this 200-day moving average. And when that happened, as we had talked about last month, that was part of where we were going to make some changes. And in this particular case, it dropped rapidly. Now, the fact is when we hit this place, we were already prepared to make a few moves. And then on this day here, August 19th, was when we had a number of corporations come out and start talking about layoffs for the end of the year. And when that happened, we had a significant drop in the market over the next 2 days. Wasn't the end of the world, expected a little bit of return, which we had. And then we came out and the Fed started talking about lowering interest rates. Another very quick drop, way faster than what I was hoping. And normally we would have had a few more days in this, it just did not work out. So what happened was the market went down, hit a bottom based on these previous floors here, went back up, but it became obvious we were not going to get back to the 200-day moving average. And so right about in here is when we decided to go ahead and move our most aggressive portfolios, profiles 6, 5, and 4, into more conservative positions. Because as I've told you all along, we want to react wherever possible to make sure we lock in whatever gains we have or keep the money there so that when the changes do happen and the market starts back up again, we have more money to work with rather than less. And so we've made these changes and quite honestly have avoided a lot of this. Now, that doesn't mean that we don't have some market exposure. We do, because whether it's even profiles 3 or 2, we have some market exposure, but it's much, much smaller. And it's designed for us to keep a hold of as much of the assets as possible so that when the times come and these reverse and we start seeing better technical analytics, we want to get back in because the trend is our friend and take advantage of that opportunity. So again, as I've talked about in the past, I can show you more in next month, or if you have questions personally for your accounts, be happy to review that with you, how we're going to make those adjustments. As always, not interested in day trading. That's not what this is about. This is about using the trend as a way to identify what's happening and using the fundamental analysis on the economy or industries or individual securities to determine if we should be invested, and then using these technicals to decide if we should be invested today. And so with that in mind, what we're always working to do is this, is to, there we go. Is to make sure that when we have our portfolio drawdowns that we have minimized risk as much as possible. A 25% drawdown, for those of you who've seen this, just bear with me for 1 minute. For those who haven't, this will be something helpful. A 25% drop on your portfolio takes it down to 75,000, starting with 100. It takes a 33% return to get us back up to even, to zero again. If we have a 40% drop, it takes a 66% return to get us back up to even. And a 50% drop takes us 100% to get back to even again. And so we try to minimize downturn as much as possible so that when the time comes that the economy is working in our favor, that the trend is our friend again, then we can go back into those portfolios that more closely match your current risk tolerance, not with just the money that we had before, but actually to take that and make that work better for you at that time. So what do we do on the months in between, whether those months are just a couple of quarters, or what happens if it's a year or two like we had back in 08 and 09? What do we do in between? Well, we try to make decisions that will make money during those times. One, we can adjust the portfolios to more conservative positions to protect the portfolio against further erosion, which is what we did in all of our more aggressive portfolios, the top 50 percentile. The bottom 50 percentile were already more conservative. Two, we continue to review the fundamental and technical analytics to make a decision on when it's time to get more conservative, or the reverse, get more aggressive based upon opportunities we see in the analytics and the sector rotation and some of the other items that we use to make these decisions. But most importantly for today's conversation, we utilize assets or securities that are negative correlators to the overall equities market, things that can make money when the market's not performing well. And with some of those negative correlators, it gives us the opportunity to increase either growth opportunities or protect principal, or grow, have a growth protected model for that, which brings me to why we have our guest tonight. Because when we look at dividing up portfolios, we want to make sure that we do them in the wisest way possible, whether it's using cash reserves or bonds or equities, real estate, tangibles, currency, business interests, which are more alternative equity kind of programs, or even insurance annuities. With that, it brings me to the point that I wanted to have Kendall Dunn join us tonight to talk about how we can use barrier and buffered certificates and notes as a way to help us protect portfolios and maybe grow portfolios either through growth or income during this time. We always want to diversify your portfolios. And so even to the point of if we're using any of these products, not just these on the circles, but even some of these structured products with barriers or buffers, we wouldn't want to use all of it. If we're putting a big chunk of money and we want to diversify among several institutions inside the portfolio, as you'll see here, I typically tend to think of this as in the bonds or notes area. So while we can use bonds and funds, bond funds and ETFs, right here, barrier buffered CDs and notes, we can do these inside of managed or unmanaged brokerage accounts, depending on what we're doing with them. And then of course, we do have our third-party administrator with AssetMark. That's for the bond portion of this mixture. I would also say that we use it for equities as well, because as we talked about before, buffered and barrier CDs and notes could have a growth model into them. That makes it so we're not only just looking at growth stocks, funds, and ETFs where we have no protections, even brokerage accounts where we have no downside protection. When I say no protections, I'm talking about not SIPC or FDIC, but just nothing, no buffers or barriers. This gives us an opportunity, especially in a more volatile market, to have more confidence with that. And while I love all of these, the reality is in a more volatile market, this might give us some opportunities very much worth investigating for our portfolio mix for those of you who are wanting to be a little more aggressive, but wanting some protections, or wanting to produce some of those nicer income levels and having an opportunity for growth simultaneously with that. Again, just a quick reminder, we have our 4 complimentary wealth management apps that are available to you from our website. You go to frankreynoldscompany.com and you hit login. It brings you here for your wealth management dashboard. Helps you here for your investment management dashboard. This shows everything you have. This shows what we're working with, so you can see how we're doing. Your risk reward evaluation to help you assess where you are in your portfolio management versus what your risk tolerance is. And then for those who are interested in return on life, your financial life plan helps us identify life transitional issues and life goals that you have. So please, for those of you who are using it, I know you love it. For those who haven't quite used it yet as much, please, we want to talk more about it because it is clearly a great tool to help you maximize return on life with your portfolio, your retirement, your tax, everything we're trying to do. These 4 applications help us do that quite well. I told you I was going to just hit on this just as a primer, but next month I'll go into more detail. Taxes, taxes, and more taxes. The #1 expense paid by American families during their lifetime is indeed taxes, way more than anything else we have. Ultimately, all income from whatever source is taxed. When we look at how our income comes in, we basically only have 5 choices. We can give some of it away, we can save and invest some of it, we can pay taxes, we can repay debts, and we can live off the rest of it. Typically, there's a difference between how people that build wealth function with these 5 items versus people who don't build wealth, how they function. And I'm not going to go on that tonight, but there is a significant difference in how the 2 groups function. For the purpose of what I want to remind you of tonight, taxes. We are always trying to reduce your TFE, taxes, fees, and expenses. And so by reducing your taxes means you have more money to apply towards your goals, because once you get past these 5 outgoes for income, giving, saving and investing, paying your taxes, paying debts if you have them, and then living off the rest, what you have to work with then is right here. You can take this, it creates appreciation of assets, growth in net worth. That can then be applied to long-term goals or short-term goals too, but long-term goals like family needs, more financial freedom, freedom from debt, if you're trying to do this up here, business opportunities, lifestyle desires, and charitable giving. If you have bigger gifts than just income gifts, you're looking at asset gifts. The fact is, tax planning versus tax preparation are 2 significantly different things. Simply put, this, that all of your tax preparation, or tax planning, I'm sorry, ends on December 31st. I say that 98.5%. I'm making that number up, but it's the bulk of it, to be honest with you. It's 98, 99%. You have to have these things in place by December 31st. And what happens going on to January 1st until April 15th is where you put all these pieces together. You might be able to do some qualified plan contributions January 1st and later, but if you have not done all of your tax planning before December 31st, you may be leaving money on the table that's going to go to the IRS. And there are opportunities to help minimize that, because inability to pay taxes owed is a symptom of poor planning, and getting a large refund check could also be a sign of poor planning. So we want to maximize your wealth to get you the most appreciation, growth in net worth, and achievement of your long-term goals and return on life. So what are some of those taxes? You got property taxes, sales, state and local, intangible taxes in some states, income, federal, state, city, county, depends on what state you're in, Social Security and employment, federal taxes, use taxes, federal, state, local, gift taxes, federal, inheritance, state and local. A state also could be federal taxes. I want to discuss more of this next month, how to reduce any or as many of these taxes as we can for your situation. If you can't wait until next month's Your Financial Journey webinar, you can email Kayla and I'll be happy to schedule time to discuss that with you sooner rather than later. Because again, we've got to get whatever you're going to do done sooner. If you call me on December 20th and say, hey, can we reduce these taxes? Honestly, it's too late by then. We need to be having almost all this in place by November at the latest. So please, if you're interested in some of these tax discussions, please see me sooner rather than later. Otherwise, I'll be talking a little more detail about that in the October Your Financial Journey. All right, so got time for questions here. I'm looking at the time. I'm 3 minutes over. I don't want to take too much time, but I will certainly slow down for any questions you have. I'm watching to see if anything pops up. In between now and then, though, the next Your Financial Journey update will be October 18th, where we're going to spend time, as always, talking about how to create, grow, protect, and preserve wealth. We'll take a look at some of the market fundamentals and technical analytics. Hopefully, things are going to look better. Not sure I expect that, but we'll see what that looks like with the analysis and expectations for the economy, as well as take a look at tax items like planning, investments, insurance solutions, and so on. As always, taking time for answers for your questions. So here's what we said we would do, and we've done all of it. Market economic review, portfolio management, diversification options, reminded you of the apps, just kind of primed up the tax tactics talk for you. and then we'll see about questions and the next update. And then what I'll tell you all is if you have any questions, you can email Kayla, and she'll be happy to get that to me, and then we'll follow up with answers for you. Also, if you have other friends who you would like to invite, we had a couple of guests on here tonight. If you have other friends that you'd like to invite, please feel free to do so. Just let Kayla know, and she can more than easily invite them to the next one so they can learn some of the same information you're gleaning from as well. So with that, please be careful. For those of us in Florida, watch out for the hurricane, plan wisely, be careful, and I will look forward to talking to you soon. And again, if you have any other questions about anything else we've talked about tonight, as always, we're here for you. So have a fantastic night, and I look forward to talking to you all soon. Have a great evening, and again, be safe. We'll talk later. Bye-bye.